That's incredible.
Hello?
All right.
Okay, let's do this. So first, before we start, I do want to say, since we were all finishing up lunch, if anybody, please do not be shy about getting up to get a drink, a snack, a sandwich, whatever. Please carry on.
The desserts are really good.
Oh, okay.
Yeah.
It's good to know.
Get the dessert.
Get the good color over here.
Yeah.
To kick things off, my name is Kerry Kantin. I'm the U.S. Bureau Chief for LevFin Insights, a sister publication to CreditSights. My background is the broadly syndicated loan market, which is a space that has been significantly impacted by private credit in recent years. But everyone, clearly markets have evolved a lot in recent years, and credit intersects a lot of markets. Can you all just introduce yourselves and, talk about how private credit factors into your role?
Sure. Hi, I'm Winnie. I'm the global head of strategy for CreditSights. Spoke earlier. Private credit comes up in pretty much every conversation that we have as a strategy team with clients. And oftentimes the question is, what do I need to know about private credit? And so strategy has had to get a bit smart on what things people should know about private credit. We put out a 3-part private credit primer series last year. We've put out some updates to that. And then my colleague, Zach, who you heard from on the financials panel, has actually had the opportunity to go and present on private credit to the Fed, the FDIC, the Office of Financial Research. So it's clear that regulators are also very focused on private credit. And we as a strategy team are trying to understand, how does the whole asset class fit in within the broader public markets, from a competition for assets with asset managers, and also from a providing liquidity perspective for infrastructure financing, LevFin financing, all of those things.
My name's Andrew. I'm the managing editor for private credit, also at LevFin Insights, where I work with Kerry and the rest of our performing credit team. We also cover high yield bonds. So I look at private credit in the broader ecosystem of leverage finance, and obviously have been very focused on it throughout my career. I've been covering the space for almost 10 years.
I'm Emily Knickel, and I am the head of private credit originations at AGL. And I focus on the boring kind of private credit, so just direct lending. We focus on senior secured direct lending to upper middle market and large corporate borrowers. We're relatively new private credit business. So we've launched the business about 18 months ago and deployed about $1.6 billion in about 45 credits over that 18 months. And the other thing I would say that might be relevant to the conversation is that we have an AGL Barclays relationship, strategic collaboration that I helped structure when I was on balance sheet of Barclays.
Thank you. My name is Ildiko, and I have a Hungarian accent because I always have the question at the round tables. I just joined Fitch in July, so very recently. Fitch hired me from S&P Global. I was always on the securitization analytical side, actually 26 years of experience. And so I joined Fitch because
I'm trying to
have the
advance
slide?
slides and they're not moving.
Yeah.
I don't know what's happening here. Can someone help with the slides? Yeah, I have it in my hand.
Well, in any case, I joined Fitch because Fitch recognized that the customer base changed.
Oh, there we go.
Very good. So Fitch actually established a brand new team called Strategic Institutional Account Group. And I just want to segue into private credit. Private credit is not new, right?
It's been around for 10 plus years.
Exactly. So we don't want to make a hype about private credit, but what changed is, Fitch is a great example, S&P same. We used to only deal with bankers, arrangers, corporate issuers. Today, what we are covering is a lot of the asset managers. So what changed is the complexity, the scale, and these asset managers grew so big, they are so complex, that I dare say that one pocket doesn't really know what the other pocket is doing, and same with all the other participants in the space. So Fitch recognized this, and it established a team that is actually only dedicated, focusing, central point of contact for creating and leveraging relationship management for asset managers, investment funds, to the extent insurance companies, non-bank specialty lenders. And so it's a very exciting space. We cover 150 asset managers. You can't possibly cover 150 asset managers, but the top 30, 20, we have dedicated monthly calls, deepening into like who is doing what. And it's constantly evolving. For me, it was actually a natural transition into the role because anyone in private credit today, I focus mostly on asset-based finance, sorry. But my background is in securitization, right? So I like to joke about the 4 phases of structured finance. All IG, public, auto, student loan, credit card, mortgage, in a good way, boring type of asset classes. Like we don't want action in all the spaces. Then we saw cross-sector structured finance, which would be aircraft loan or a CRE combined with a CLO technology, right? Then you go into the cross-practice structured finance space, mostly after the GFC when the banks retreated. So here you have fund finance merging with structured, so subline securitization. Or look at, we talked about data centers. I was chuckling because guess what? A lot of the proposals that I'm seeing, it's actually the GPUs and the data centers and everything that we talked about. But it's interesting, you have a data center that has construction or completion risk. So we need the infrastructure team, right, to analyze it. Then you have a big cash flow, contractual cash flow of leases. So now you need the structure team to kind of figure out the renewals and the credit and the defaults and right, who is performing, who is not performing, what the lease factors are going to be. And then you need the CMBS team because they are going to need to analyze the value of the property at the end of 25, 30 years down. So it's really that duration. So it's very interesting to see today, our current reality, again, moving from public to the cross-sector, cross-practice, mostly 144A. Today, it's mostly private credit, but it's integrated finance. I love that word, integrated finance. Why? Because you have a rated note feeder structure, and it now spans across debt and equity. And you have corporate, infrastructure, asset-backed, real estate, the whole gamut of everything that we have seen. So this is our current reality, and that is feeding into all the insurance money, third-party SMAs. We will talk about that, asset management. And guess what? We talked about the banks. I am actually surprised it didn't come up. The banks are in the game. The banks are still sourcing. They are still structuring. And they are at the back. They are providing the back leverage, whether it's a subline or a NAV loan. So from a systemic standpoint, like not everything is visible. But the beauty of this is, right, we need to be in the game. It's such a big market.
Well, and something interesting that we didn't talk about in our prep call because it just happened on Friday.
We are improvising, by the way, right? All right.
We're getting
I'm
way
actually
off
covering
topic.
this if I know where you're going.
Yes, you probably do. 2 out of the 3 agencies that recommended the leverage lending guidelines that have really restricted the banks from participating more in private credit, and really the reason I had a job at Barclays and have a job at AGL, 2 of those 3 agencies came out on Friday and said that they think they're recommending that leverage lending guidelines are removed or loosened. The last agency, the Fed, has not yet said that, but I think most market participants think that that will happen. And so there's a big question of what's the next chapter of the bank's involvement in private credit. Are banks going to pivot from, these leverage lending guidelines that have been hugely restrictive to being more aggressive? Or are there going to be concerns about systemic risk coming back? So it is continually evolving, to your point.
Mm-hmm.
And this is just the next, version of the next conversation we're having. Is that what you were going to guess?
That's what I was going to guess. And also to piggyback off what Emily was saying, I think the question in that debate is not necessarily what is the market share, because private credit is here to stay. It's just grown to the scale that like you can't put that genie back in the bottle. So I don't exactly think that the repeal of the leverage lending guidelines or the withdrawal of that guidance will send the capital markets world back to the pre-2013 days.
Yeah.
And this is a pretty open-ended question because private credit is a sprawling market. But How does it fit into a portfolio? What are some of the use cases here?
Yeah, I'm happy to jump on that. Look, AGL, we're a specialist in corporate credit, non-investment grade corporate credit. And we have capabilities across both broadly syndicated and private credit markets. Broadly syndicated, liquid, public. I'm going to use all of those to mean the same thing, and then illiquid and private markets to mean direct lending, which is what we do. I spend, and having spent time at Barclays and setting this up, I spend a lot of my time in thinking about the public and private markets and the convergence of those two markets. And just to give you some stats, Winnie, I did this for you.
Oh, thank you. I love a stat.
According to the CreditSights third quarter review, 13.1 billion of private credit loans were refied by BSL in the third quarter, and 15.5 billion of BSLs refinanced by the private credit. So a net win of 2.4 billion for the private credit markets.
Something to write about.
In volatile times, I would expect that number to be much larger because the banks tend to shut down a bit, and the syndicated markets really, will shut down for 1, 2, 3, 4 weeks, depending on how big the volatility. But in any other quarter where there's not volatility, I would expect that number to kind of, swing back and forth around zero, net winning on either side. And that just speaks to the convergence of these two markets. Now, what are you getting by investing in the private market? You're typically getting the illiquidity premium, which is anywhere from 100 basis points to 300 basis points, depending on the volatility, the volumes in the markets, et cetera. And you're getting a whole host of other things that we'll talk about later in terms of why a borrower would choose one or the other. From an asset allocator, so if you're a pension fund allocator, my LPs, they're choosing private credit because of that illiquidity premium that they're getting over the public markets. And at the end of the day, it is a senior secured loan where you're getting an attractive absolute return, right? You're getting high single digits to low double digits. That is incredibly attractive when you have the first lien on the assets of a company. And so that's why people invest in it, and the slight difference between the public and private markets. But at my shop, we're just corporate credit specialists, and we have a solution for either market.
So for ABF, more stats. A 2-3 year traditional auto ABS, investment grade, credit card ABS, mortgage ABS, or RMBS, investment grade, anywhere from 30 to 50 basis points spread. Non-investment grade, right? You guys are, this conference is focusing on IG. So non-IG, about 100 basis point above that. So 130 to 150. Private credit, 230 to 250, and it's all investment grade.
Yes.
So it's truly that it's the illiquidity premium. The spreads are tightening because of the convergence, but I also say because it's really the insurance money that is taking this, and insurance companies may not necessarily care about illiquidity or liquidity. They don't do mark to market, right? They don't care as much because they are there for the long haul, long duration annuities and retirement money, right? And retirement obligations. But we always talk about illiquidity and complexity, but how about premium for speed?
Yep.
Certainty of execution, right? All the bilateral goodies that you get when you're in a private credit space. From a rating side, we saw a ton of data on these deals. I mean, transparency maybe not for the public market, but people who are involved, right? And I just want to really emphasize before I forget, none of the agencies differentiate the methodology between private and public. So if you come in with the same data center, right? I'm not going to look at a methodology because it's private credit going into a private rating letter, right, rationale versus a public rating. No, we are consistent, and we absolutely have to be cautious and selective, but we also have to be consistent, and we also have to be transparent, right? So.
Well, let me flip that question around a little bit, because clearly from the perspective, if you're an investor, you're getting, and you can get comfortable with the buy and hold risk, the premium is significant. But if you're the issuer, you have to pay more to go private credit. Can we talk about some of the use cases for private credit?
Do you want to start, or I'm happy to jump in?
Go ahead, please.
So I think that we'll talk about the borrowers that have the choice between the private credit and public markets next, but some issuers can't tap into into the public markets. Typically, CLO managers, large CLO managers, which are typically the buyers of BSLs, um, have a minimum tranche size of anywhere from 300 to 500 million because they want to have liquidity in the loan, which means you have to have scale in the loan. And so if you assume the average borrower in the leverage loan market has 4 to 5 turns of leverage, you really have to have north of 100 million of EBITDA, maybe even 125 million of EBITDA, to tap into that market. So let's ignore the subset that's below that and talk about the subset that has the choice. And we see a lot of sponsors today and a lot of borrowers today dual pathing the financing. So on one hand, talking to the banks about a broadly syndicated underwrite and talking to the large private credit guys about a private credit underwrite, which is the whole reason I have a bank asset manager partnership, so we can serve both of those up. But Ildi touched on a couple of these things. Confidentiality, to utilize the private credit markets, you get more confidentiality, you get speed of and certainty of execution. When private credit prices risk, we price the risk with no flex terms, and banks always are going to have flex terms with their underwrite to compensate for duration risk when they're holding before they go to market. We don't require ratings. We offer very, very large delayed draw term loans, so unfunded debt in the capital structure to allow the borrower to go and execute on an M&A roll-up strategy. We also offer PIK interest, and so we don't force our borrowers to pay cash. And then we also are going to dig in a lot more on complex stories. Don't require, audits. So carve-outs tend to come to our market. So there's a lot of benefits that offset the fact that it is more expensive. And I thought LD brought up a great point, which I kind of worked in somewhere later, but there is an asymmetry of information that is shared with private credit lenders versus public market lenders. And I sometimes think that the headlines get it wrong and they focus on, the fact that the public markets can't see everything that private credit lenders have. Our LPs see everything, and we get far more diligence in our diligence process before we lend money than the public markets. And so the asymmetry of information is actually in favor of private credit versus the public markets. And I think there's a little bit of misunderstanding there that the public markets have.
So
Did I leave anything for you to talk about?
mostly, well, kind of. No, what Emily said is all correct. I do also want to emphasize that the phrase business in transition can sound like code words for distress, but they don't necessarily have to. It could be something like, pivoting your geographic footprint, taking a quote unquote gamble, on a new product line. Those are the types of things that banks might not necessarily be super into financing. They might not be that keen on it. But it's something that private credit lenders can do. And one of the interesting things about the delayed draw is that it's not only good for smaller businesses like lower middle market or core middle market businesses that want to have a buy and build atmosphere. It's also great for a larger business too, because in times of stress or distress, obviously the syndicated loan market can lock up. And so when that's not there, are you going to be able to get that incremental debt financing to make that opportunistic purchase? And when I say opportunistic purchase, again, I don't mean distress, but if there's some maybe dislocation in the sector and you can get a business at a really attractive multiple that you might not otherwise have been able to. There's that one. And then also one of the things that's worth noting is the certainty of close. I think that definitely comes in most handy when times are tough. But as we saw right after the tariff announcement, there was that maybe 6 to 8 weeks of just absolute chaos. There were a couple deals in that market that didn't get done, and they had to be funded by the underwriters, right? And you think of 2025 as largely being a really solid year for the markets, but that little one specific place, private credit certainty of execution would have come into.
And just because you mentioned Liberation Day, which I still can't say with a straight face, the private credit markets shut down for it happened on a Wednesday or a Thursday.
Mhm.
I heard of one deal that got renegotiated over the weekend. By the way, that sponsor will never talk to that lender ever again. And then by Monday, we were pricing risk at the exact same price as we were pricing risk the Tuesday before Liberation Day. So there was really just we talked about it a lot. We talked about what's the impact to our portfolios, what's the impact on the underwrites, but we continued pricing risk. Whereas I completely agree, there was a shutdown window on the public markets.
Just sorry to tag on to what Emily was saying there. We have this partnership with Lincoln International. Don't know if they're in the crowd, but if they are, solid work. They provide us with a snapshot, which is the going market terms on leverage and interest spreads. And when the first snapshot comes out twice a month, came out after the tariffs, it spiked like 50 basis points, and then it largely reverted to the mean on the next one. It was crazy how quickly the market shook it off.
Yeah.
Well, delving into the investor base a little bit, because as private credit is a sprawling place, how does it differ if you look in sort of infrastructure, IG, ABF versus, or does it at all versus the, kind of the leveraged private credit that is a competitor to BSL?
I can start with
Yeah.
that. So I consider private credit when it comes to like more my area, ABF, asset-based lending, as private credit 2.0, because you really pivot away, you diversify away from corporations or corporate loans. There's so much of this stuff, right? $6.5 trillion today without real estate. Around, the numbers are all over, but like let's say 25 trillion, including real estate. Right? The projections linger around $40 trillion, but why? We just talked about it, right? 10 trillion in infrastructure investment, of it just data centers, 1.5 trillion. Grid, and this panel, grid improvement, right? I used to do all the coal mine decommissioning deals back at S&P. How do you depreciate GPUs? I mean, we talk about that every day. But we all focused on AI and data centers. What about the 17,000 aircraft backlog by the OEMs, right? Boeing and Airbus. What about the 3 to 4 million housing shortage? What about the 10 billion people in 2080 and the electricity need, like that we will all have, our kids will all have? Who is going to fund that? So on the one hand, I find it fascinating because there is so much demand and so much need. And by the way, we in the industry, I always feel like we are doing an incredibly important thing here because we are really funding for the future. On the other side, right, the flip side, we keep saying there's so much capital, dry powder, the retail space is moving in, so even more capital chasing the same assets. But it's interesting. On the one hand, you need this huge demand for assets. On the other hand, we are saying there's too much capital. So, I mean, which one is it, right? but for ABF, the way I think of ABF, what's the commonality? It's all long-term capital sources chasing long duration assets. So what you really want to do is unleash alpha by monetizing contractual long-term cash flow, right? Basically, that's what's in it. And as long as you have a high enough capex that hopefully will have some value, and again, like we talk about this every day, data center is in 25, 30 years. When the ground lease is owned by someone else, like how do you really value that, right? But there may be some value to that. So as long as you have stable operational, like the OPEX, right? And then you have the CAPEX that you may have value at the end of these deals, that's basically what asset-based funding is. And just going back to, it's really interesting, like really the risk appetite, right? So you look at Apollo, and I mean, everyone knows, so I'm not going to say let's not name them. So Apollo is the one extreme of asset managers. They can offer the entire capital stack in-house. The seniors for Athene, a CLO funds of funds for the mezzanine, and a bank, back leverage LBO, right, for their equity piece, the JVs, the joint ventures that, you all hear about. But one of them is somewhere there. So right? That's one end. So they have the appetite in-house. Good for them. Some of the other asset managers, especially the smaller ones, they're managing monies for third-party SMAs. So they basically, right, they offshore the risk for some other risk takers. And so the risk appetite may be a little bit different. Again, just to back up, from a rating standpoint, we do not make a differentiation. But when you talk about ABF and who has what type of appetite, you certainly want to talk about the long-term nature of these deals. And of course, liquidity is so important. So I'm old school ABS, right? The cash reserve, the triggers, the hyper turbo. You don't want a refinancing at the ARD because we rate to the legal final, right, of that maturity. So at anticipated repayment or expected final payment rate, you may not be able to have that investor to refinance. And then really what happens? And I at S&P, I kept getting these phone calls from investors like, oh, the rates are so high, nobody's want to, refinance. Like, the bond is due, what's going to happen? I'm like, well, we rate it to legal final. So for us, that's not an EOD. That's not an event of default. So it's just interesting. Again, there's so much, but when you talk about ABF, I talk about this diverse asset-based lending that are basically self-amortizing. You monetize the cash flow, you get principal, right, ahead of like a corporate lending where you mostly have the bullet payment. And then you have basically, whether it's the tenant or the lessees, in a triple net deal or an aircraft deal, you have the credit quality upfront of the people who are paying the leases or the rent, and then you have the leases, right, the OpEx, and then you basically have a metal or a liquidated physical asset that when you didn't pay down the bond, you may want to like size for that or quantify that. That's how I think of ABF. Yeah.
When I think about the landscape and the players in the landscape, I have a fancy page I have in my marketing deck, but it in the direct lending side, you've got the really complex players like an Apollo who does everything, to Ildi's point, and does everything very well. I would put other players like a Blackstone, right, that has a private equity house. They have private credit, they have insurance, they do everything. So there's the players that are doing everything. Then I think a lot about the asset manager bank partnerships and what they're bringing to the table. And then you have the pure play players, and that could be true in the direct lending market. It could be true in distressed lending. It could be true in ABF. Like, you have just people who are focused on one niche and they do it well. And so it's a very complex landscape. And I think at the end of the day, you have to, as an asset manager, you have to think about, who are my LPs? What am I pitching them? What I'm doing? How is that differentiated? And then based on that, you have your own unique set of key players that you're going to compete with on a day-to-day basis. I don't know if that was the question, but.
And sorry, just to tag on, like even traditional platform players, student loan lenders,
Yep.
auto players, they are all in private credit, but now they are doing the upfront capital commitment of forward flows and warehouses, right? Or look at the SRTs or the risk transfers, right? So these are kind of like the platform based, but again, the structures may be a bit more complex,
Yep.
right? But the assets are the same.
Yep.
Yeah.
You alluded to this a bit earlier, Emily, when you were saying the type of information that your LPs get. But just given that it isn't a public asset, what are some best practices around transparency and due diligence? Is there anything you walk through, broad strokes here?
Yeah. It's a timely question. I mean, there's I think a lot of people in the room probably know that the last 24 months or so, there's been kind of historically low M&A volumes, and there's been a lot of fundraising in our markets, and so there's a lot of dry powder available. And so I say that all to set the stage for within my business and our firm, there's a heightened sense of focus on what is the diligence access that we're going to get and what is our timeline to do that diligence. Because when you combine low M&A volumes, low deal volumes, and a lot of dry powder, the borrowers have a lot of leverage. And so they can say, hey, are you guys interested in looking at this deal? You have 3 days to get back to us. Well, I can't do real diligence in 3 days. And so my firm has taken a stance where, we need adequate time to do our diligence. And I did say it earlier, there's an asymmetry between, what the private markets get and what the public markets get. We actually have a wall within our organization because we don't want to restrict our public side from trading in names where we have access to information that they don't. There is a cleansing period, and we'll eventually share information. But we would expect in any diligence process to have ample time. That can be 7 days, that can be 6 months. It just depends on what the business is and how complicated it is. Is there a sponsor involved? Is it a founder-owned business where you're doing everything yourself? But ample diligence time, third-party market reports, quality of earnings reports, access to the company's management team, access to the deal team, at the sponsor if there's a sponsor involved, and then obviously counsel and time to document the deal to our liking. So there's a lot that goes into the diligence process, and then on the back end of a deal, in terms of reporting, again, it depends on the company. If it's a lower middle market or a middle market company, we just did a deal last month for a founder-owned business, 80 million of EBITDA, so it's a sizable business, growing very rapidly, tied to data centers and the building of data centers. It's a founder-owned business, and so we actually have monthly reporting, not quarterly. And the more large corporate you get, it's going to be quarterly reporting. It's going to be very similar to what you see in the public markets without all the MD&A. And if you think of a 10Q, just wipe out all the pages of words and just look at the numbers. Like that's what we're getting on a quarterly basis. And I would expect for all of our private deals for us to have access to management on an ongoing basis, as well as the sponsor deal team.
Well, that brings us to the topic of risk. And sort of what are sort of the main sources of downside risk and how do you mitigate that?
Do you want to start, Winnie?
Sure, I'll start. I've been quiet. So I think that what comes up most frequently with clients is, how can we be certain about the credit quality within private credit and the risk that all of a sudden we have this big default wave, and that's going to put pressure on public markets because that's where people are going to have to be raising liquidity, and all the LPs are saying, get me out, get me out. And how do we kind of calibrate that? And so that's one thing that we focused on a lot, especially in 22, 23, when the public markets were kind of going through it. Private markets were actually a tremendous source of liquidity. I think that's one of the reasons the high yield default rate stayed pretty low. The broadly syndicated loan rate, default rate stayed lower than it maybe would have been. You saw this kind of nice transfer of, privates here and ready to provide liquidity through whatever this transition period is going to look like. And so I think the question is still there. And what we always think about is, okay, are these private portfolios diversified? Because theoretically, if there's enough diversification, then you're not going to have this kind of like systemic thing just lurking within private credit portfolios. I think, of course, we have to think about sector concentration and what has been really popular with sponsors. And are there risks that we see some sort of cyclical issue within, software services or healthcare, whatever it is? But that's true of public markets as well. It's not a private credit necessarily specific thing. It's just that some of the issues could be amplified given leverage points, et cetera.
Anyone else want to chime in?
One of the things that is worth thinking about also is, are the businesses realizing their growth projections? Of course, if the business starts missing growth marks and you just say, it was a bad quarter, we'll get it next quarter. And then you say that a couple times and all of a sudden the business is off its growth plan. And that matters obviously for a lot of reasons. But one of the key ones being, are the EBITDA adjustments being realized? Obviously, the EBITDA adjustments are put in there with certain assumptions. And if those certain assumptions aren't met, then all of a sudden the leverage profile that you anticipated at closing looks a lot different in reality.
Let's see. I'll maybe tackle it from a slightly different perspective, the lender perspective. I think when I think about our IC meetings, we kind of have 4 basic things that we're looking for an investment to really hurdle. Strong cash flow, compelling industry fundamentals, so liking the subsector, high barriers to entry, and then downside protection. So what's our second way out if we can't get a refinancing? We spend a lot of time on those 4 key points with any investment that we're looking at. On top of that, we talk about all the things as a committee that you would expect us to talk about around risk. We spend time talking about tariffs, any sort of political risks or regulatory risks. But the number one thing as an IC that we spend a lot of time thinking about is AI. And I'm amazed that we made it to this point in the
Bingo.
conversation without saying AI. It has increasingly over the past 12 months, really. Not to say it didn't exist in the conversation before that, but the amount of committee time and committee mind share that is taken on is AI. First of all, what does AI look within our existing portfolio? And we have we don't have a big legacy portfolio, so we're very lucky in that. We've been thoughtful about that since the beginning. But any new investment, is it a tailwind? Is it a headwind? If it's a headwind, what is the bar to hurdle to make a 7-year loan? Like, how much information do you need to have to feel confident that you know what's going to happen in that space in 7 years? That's hard. There's so much that none of us know about how AI is going to impact these businesses, particularly in the software space. And I think if you look at the public markets, if you look at the broadly syndicated market, there has been over the last, keep me honest, 6 to 9 months, a huge wave of loans going from par trading to
85s, 70s,
50s,
yeah.
60s, 70s, and they're performing. They're performing very well, but there's just this, I don't know what's going to happen, and so mass selling. And it's been a fascinating thing to watch on the public side. And it's happened in all the obvious spaces, but some in spaces that you wouldn't kind of expect. There's just some really out of favor subsectors, and it all ties back to AI risk. And so we have this kind of real time, constant debate about what is that bar to hurdle? How much do we need to know? And nobody has a perfect answer to it, but it takes the vast majority of the mind share of RIC.
It's an interesting segue on that AI point, because yes, we've watched it's like one name in the sector, someone starts worrying, and then it starts bleeding into others, even if it's not a direct comp. And some of these companies, my understanding, have spent the vast majority of their earnings calls just talking about AI. But one thing someone did mention to me, and this was a sponsor, and we were talking about a portfolio company of theirs that had, gotten banged up a bit. And he actually was saying that he thought that this was where private credit, because you're in it to own it, it's, if you only own a couple of million,
the paper,
something,
not the company, just
what?
clarify. I said that being the paper, not the
company. Yes. To clarify, you're only, that it might be the due diligence might be stronger, just given you don't have the ability to trade out of it. It was just an interesting comment of how, because I definitely expect that to be thematic next year. Anyway, continuing on the topic of risk, but what do we think about potentially leading into public markets?
Can I start on that one?
Please.
So I think this is something that's underappreciated because we mainly look at risk from what does it mean for the corporates, but this is particularly true for private credit because for the most part, the private credit folks are asset managers overseeing third-party money, and a lot of that, of course, comes from pension funds, insurance companies, et cetera. So the idea that, if there's a big public market downturn, that means their equity portfolio obviously would tank. And all of a sudden the question becomes, what does that do to your portfolio allocations? And what does that mean for the way that you have to treat those assets, right? If you have a portfolio of $100 million and then, the equity falls a lot and you have $5 million of private credit, all of a sudden that share is way off. So that's one thing to think about. And then also, obviously, I think Ildi and Emily hit up on it. There's the leverage facilities, fund level leverage, as well as the sublines and NAV loans that banks provide. So there's interconnectedness in that way too.
So I would say definitely on the kind of public-private risk transmission mechanisms. We heard a lot about it from the financials panel earlier today. And then also just thinking about the evolving regulatory environment. You know, we've seen deregulation be one of the major themes of 2025, but we do have regulators looking at private credit right now really closely. And the NAIC is trying to figure out, you know, do we need to make any sort of changes to our methodology here? And we also can't presume that we're going to live in the same regulatory regime in perpetuity. And oftentimes, you know, major changes come with some friction and some tensions between public and private. And, you know, to Illy's point, just the sheer amount of funding and financing that needs to get done for a wide range of things, that it's a big number. And as you think about changes to how much capital can flow from any one pool, that does sometimes mean there's going to be a recalibration of, oh, actually more funding is going to need to come out of the public markets over time versus private markets and vice versa.
One thing that I think about a lot with regards to kind of the risk and the interplay between the private and the public markets is this phenomenon that we've really seen over the past 12 months of retail dollars flowing into private credit, with some of the big, you know, publicly traded BDCs. I don't have an answer, but like what's going to happen when there is a big market sell-off and all these, you know, less sophisticated, you know, retail investors are trying to get their money out, and there's just a fundamental mismatch in, you know, liquid like publicly traded BDC and 7-year loans. And so it'll be interesting. Like these guys have had a tremendous amount of success with fundraising. And they have a lot of dollars to deploy, but what's that going to look like? My guess is we're going to figure it out. And everything's going to be fine, but there is a reason that there's a concept of a QIB, a qualified institutional buyer. It is, you know, it's just a different investment.
And one of the things that I think is super important on that for the retail investors is, you know, public perception, as we've all seen in the headlines, is important. And the question will be how many folks, retail investors, go into this eyes wide open, right?
Yep.
Obviously, direct lending is, you know, a strategy, but lower middle market looks a lot, direct lending looks a lot different from large cap.
Yep.
Documents different, businesses different, you know, so that's a lot of education. These people thankfully have other jobs than, you know, private credit, but that's an important factor.
Oh, we are out of time. I can't.
I
have so
know.
much to say.
I know.
All right.
All right.
Do we want to take an audience question if there is one?
Yes.
We can.
Think we could sneak one in?
We've taught you all there is to know about private credit.
Or we put everybody to sleep.
Either way.
Probably the latter.
Probably after lunch, yes. All right. Well, then we're going to take about a 10-minute hiatus before our next panel. So that'll be at about 1:45.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.